What is up, YouTube? This is the Working Investor. In this video, we're going to look objectively at CONY and QQQY. And I've done some back testing on these two products, and I've compared them to the actual underlier, and we'll see if it makes sense from a total income investment. I'm just going to present you the information. You guys make your own conclusions. So CONY is from YIELDMAX, and QQQY is from DEFIANCE. CONY is a synthetic cover call ETF from YIELDMAX, and QQQY is a synthetic cover call ETF by DEFIANCE. So let's start with CONY. So I looked back at CONY, I looked at different sources to try to figure out what the total dividends have been. The total dividends since October, even though they came out like sort of in August of last year, I believe, there was no payment in September. So they paid out a hefty $19.48. On inception day, on August 15th, 2023, it was trading at $20.31. Today, pre-market, it's $16.35. So loss in net asset value total is $3.96. If you take the total dividends, which is $19.48, subtract the net asset value depreciation or decay, you still have a total of $15.52 that you have in your pocket if you opened it up from inception. And if you divide 1552, subtract by the initial price when it started trading, that's a 76%, well, 0.76, which is it's 0.76, which is 76% total return, which is incredible as a total return investor. But if you want to compare it to Coinbase year over year, Coinbase had a phenomenal year this year, so it actually is up 170% if you held the underlying. And, past performance is not indicative of future gains, but if you want to understand, like, the dividend capture, because synthetic cover calls capture some of the upside, not all the upside, so I divided the 76 by 170, so it basically captured 44.7%. That is what the synthetic cover call captured from the actual underlying. So if you want to expect this kind of return, you want to expect Coinbase to make another year over year 170%. You don't know if they're going to make 170% year over year. I don't know, but just an idea. But there's other factors as well, because in an up market, implied volatility is down. Maybe even in a choppier market or a down market, implied volatility could be up. So it's not very linear as we could think, but it just gives you an idea. But a lot of variables. There's implied volatility. There's all kinds of stuff that could be coming into play. Now here's QQQY. I know I've seen a lot of people invest in QQQY. I wish if somebody could teach me and explain to me why this Defiance fund makes sense and why it's so amazing. Please educate me and teach me, because this is what I found. And I was looking at the dividend tracker. Of course, the numbers are a little off because they had a 3-to-1 reverse split. So this is I assume this is adjusted based on the reverse split. I calculated all the dividends I paid out in the past almost a year, I believe. So it was $27 total in dividend, which I added up, and it's again adjusted for the 3-to-1 reverse split. It was $60.42 at inception, and today it's trading at $39.52 pre-market. So basically, there's a total loss in net asset value of $20.90. Ouch. So, but you did get $27 in dividends, and you lost $20.90 in net asset value. So you're walking away with $6.10 over almost like roughly the most of a year. $6.10. But if you divide $6.10 by the initial, when it started trading at $60.42, that gives you about a 0.1%, 0.1 or 10% return in about a year. A 10% return in a year, really, guys? And also you have to, everyone's circumstance is a little different, but you have to also realize that the $27 in dividends is you're going to be taxed on that. Unless they consider a return on capital. I don't know how they do it exactly, but that can totally eat into your 10%, like a lot of it. So I'm not sure, guys. And if you want the QQQ year over year, the underlying that it tracks was up 31 and a bit, 31% year over year. So it captured 32.2%. This is what the synthetic covered. So the CONY captured 40, did a better job capturing the actual growth. This only captured 32.2%. The reason why I talk about what percent it captures is because you can't, I feel like it's better to compare underlying A to underlying B, because I believe very much, and I know other people share my opinion, a lot of funds are very dependent on the fund manager. If you have a really good fund manager, they know how to work these strikes in these ETFs and know how to do because the market does what the market does, but you can see that Defiance only captured 32% of the gain, while YIELDMAX and CONY, different product, but of this gain it captured 44%. Of course, if you want to compare apples to apples, you could find another company that does a synthetic cover call ETF in the Nasdaq. Maybe you could look at Roundhill, but Roundhill does it looks like options and futures, a slightly different product, similar but a little different. But you could look for, and it's a different strategy. It's 0 to 1 day to expiration, but you want to see what percent of the capturing of the upside relative to the underlier. So that's my 2 cents. If somebody could teach me and explain to me why QQQY, why a 10% return is total return is something superior than getting, I honestly believe we could do better than that. I mean, objectively speaking, you could do better than 10% return. I feel like the people who look into QQQY are looking only at the dividends because they are juicy dividend, $27 in dividends, but they're not looking at how quickly this thing is eroding. Maybe they believe that there's going to be range bound, but maybe the range could be 0. I don't know. It keeps reverse splitting. I don't know. Please, if someone could teach me, maybe I'm wrong. I leave my ego at the door. I just want to know what the best way to make the most money is. We're in it to win it together. But please teach me why people, enlighten me, why 10% return is so superior. Total return. Anyways, this is the Working Investor over and out. Food for thought. Hope you guys have a wonderful day.